welcome back to another episode of Ask the Hammer with Jeffrey Levine from Buckingham Wealth Partners. Jeffrey, I've got another tough question for you, if you're up for it.
Yes, let's do it.
So with interest rates so low, why wouldn't I use a 30-year fixed mortgage when buying a home?
See, a really good question. And, it all depends on a variety of factors. Like everything else, we have to look at the specific set of facts and circumstances and what your own personal plans are, as well as what your beliefs are for the outward economy. But let's start with you. If you're not going to be in that home for 30 years, you're planning on being there for a shorter period of time, maybe 15 years, well, then obviously you don't need to lock in a rate for 30 years. That doesn't mean you're not going to spread those payments out. Doesn't mean you've got to take a 15-year mortgage and scrunch up your payments, making them higher. That might hurt cash flow. But you might be able to take a shorter guaranteed rate period. For instance, go with a 7-in-1 or a 10-in-1 ARM, knowing that for the first length of time, that whatever that is, 7 years, 10 years, etc., you've locked in a even lower rate than you would get on today's 30-year mortgage. And today's 30-year rate on a fixed rate is pretty low. Traditionally, as we sit here, it's in the sub threes, which is just it's amazing to think about. But it's if you go with a ARM in many cases, or a 15-year mortgage or something shorter, you're likely going to cut that rate even further. And so if you imagine, for instance, that you are 50 years old today, your plan is to retire at 65 and move south and get some warm weather. Well, you don't need, again, 30 years of fixed rates. So maybe you just go with something that's a 10-in-1 ARM, and you know that the last 5 years, yes, it's variable, but the first 10 years you've locked in lower. Or you end up with something that's a 15-year ARM if you can find it. So it just depends upon what your personal plans are. Because unfortunately, even if you buy another home, let's say that retirement home with a mortgage, you generally can't pick up your existing mortgage and move it to the new house, right? You've got to pay off your existing mortgage and then reclose on a new mortgage elsewhere with new terms, etc. So having a lower rate for 30 years, even if you're paying a mortgage for 30 years, if it's not that mortgage, it's not particularly helpful. The other reason why someone may opt not to go with a 30-year fixed rate today, even though it's historically low, is you believe rates will go lower in the future, or you just believe they'll stay relatively similar, right? If rates stay relatively similar to where they are today, or they go lower in the future, you can refinance a few years out. And provided those closing costs cumulatively when you refinance are less than the savings that you would have for a lower interest rate. So for argument's sake, let's say you were borrowing $400,000, and for the next for the next 10 years, instead of getting 3% on your mortgage, you were able to get 2.75. Does that 0.25% difference, if you had a 10-year ARM, allow you to save more money in interest payments over those 10 years than it would cost you in refinancing in 10 years? And if that's the case, and if you believe interest rates will kind of stay here, or again, even go lower, which is hard to imagine, but many of us said it was hard to imagine when they were 5, and then when they were 4, and then they were 3.5. So who knows? But it's possible. And so if you believe that to be the case, you can always, 5 or 10 years refinance, and presumably at the same or lower rates, or pretty close to it. So those would be your technical reasons. Now, I will say this: if you're young and you're looking to purchase today, and you want to know your worst case scenario, which for young people I think is very important, because if it's your first home in particular, you just never know what being a homeowner is like until you own one. The leaky roof or the faucet that you never really truly prepare yourself for those additional expenses. You can read all the articles you want about X% of your home price to keep in mind for up. Doesn't matter until you experience it yourself. And the second thing is that you also, as a young individual, you often have a lot of more uncertainty. Will you have 2 kids? Will you have 3 kids? Will you have no kids? Where will you want them to go to school? Do you need to pay for daycare? What will happen with your career? I mean, is a lot of uncertainty. So for a young family saying to themselves, you know what, we bought the house that we could see ourselves in, maybe not guaranteeing, but we could see ourselves here for the next 30 years raising our family. Having that certainty for 30 years can be very powerful. So again, it just comes down to what it is that you really want, and then again, what it is you believe that will happen outside. I will say one other thing though, Bob, before we go on, is if interest rates go lower, how much lower? And again, I think people have been saying that for a decade now, but it bears repeating at this point with rates again at fresh historical lows as we speak.
It's interesting, given what the Federal Reserve has said about where they plan to go with interest rates. I guess it's a good bet that they may at least stay the same for the next couple of years. So that's one. So the question I have, the follow-up is, would you apply the same logic to someone who already has a mortgage and is thinking about refinancing in the current environment? Should they apply, for instance, the common rule of thumb that people often use when you think about refinancing?
Sure, absolutely. So I think I'd split that into two parts. So first off, rule of thumb in terms of, when should you refinance? Oftentimes people say if you save a percentage or more, then it's worth it. I think you've got to look and see today, thanks to technology and other, and just frankly, the demand of some banks and lenders to do those refis, even in today's climate when everyone's doing it. Some are just trying to pull those individuals from other institutions and get those loans at their own. Some are offering breaks on closing costs or closing fee free refis. And if that's the case, and again, you got to do your due diligence and make sure everything that you're hearing is actually true. But look, if you can get a lower interest rate and not pay closing costs, why wouldn't you? I don't care whether it's 1% or 0.5%, even 1/4%. If it's just a little bit of extra work on your part, it's probably worth it. But beyond that, in terms of, do the same overall factors apply in terms of, how long will you be there and what will interest rate? Yes, they generally do. Obviously, if you're refinancing, you've already been in that house for some period of time, maybe 2 years, maybe 20 years. And so inevitably you probably have, or not probably, you would definitely have less time left because you've already lived some of it in that house. So it could be an individual, candidly, who is, again, younger and just believes rates are going to stay relatively similar. It could be someone who is close to retirement looking to sell that home when they get there in 10 years. And it could candidly be an individual who's maybe had a tougher time and struggled with expenses and was never able to pay off their mortgage, and they're 75, and now they're looking and saying, well, I still have this mortgage, but I can refi, but I'm not going to live more than another 15 years. They could, but maybe for that person, they're not thinking that's going to happen. And if that's the case, and once they're gone, the house will be sold. Again, you don't need to, we don't need to guarantee rates from the grave. So it's all about understanding how long you'll be there and what you believe future rates will be. The same general logic applies to refinancing there. But it's a great question. It's a great time. And I just point out that whether you're buying or refinancing, et cetera, yes, we're all worried about getting the lowest rates. But today we're fighting over rates of, is it 3.25%, or is it 3%, or is it 2.9, in the past, we had people that were buying mortgages with 15, and they were hoping to get 14% or 13%. So from a purchaser's perspective, and in terms of the mortgage, we're in a position that you can buy a lot more house than you used to, based on the value of the mortgage. Obviously, that also tends to increase home prices, because if buyers can afford more, sellers can charge more for their homes. So it's always that the cycle of life. But it is. From a mortgage perspective today, your lower rates mean that more of your payments from day one are going towards your principal, which is actually your own value that theoretically, when you sell your house, you can recapture back, versus going to interest payments, which is just money evaporated into thin air. So it's still, from that perspective, a pretty good deal for buyers.
All right, I'm sure this will generate lots more questions about buying real estate and mortgages and whatnot. But in the meanwhile, nailed it. And
the hammer is out. I love it.
Nailed it. So, and if you don't mind telling our viewers how they can ask more questions.
Yes, we want to hear from you. This is the thing that gets Bob and I excited and jumpstarts each and every one of our days and weeks and so forth. So if you've got a question for us that you'd like us to answer, go ahead and email us at askthehammer@buckinghamgroup.com. Again, that's askthehammer@buckinghamgroup.com. Thanks so much, and we'll see you again for another episode of Ask the Hammer.